Okay, so we're actually getting deeper and deeper into the interesting part of this mentorship. So today we're going to talk about market analysis, just a brief foundation of how to analyze the market in different types and forms. So being in the basic since at this point we are transacting slowly into the technical analysis. We're going to be learning the price action from this phase onwards, understanding the charts, learning how to read price, and being able to speculate and predict price movement. Market analysis in trading refers to the process of examining the various factors that affect the value of a security or asset. This analysis involves studying and interpreting financial data, market trends, news, economic indicators, and other variables to make informed predictions about future market movement. So these are it's just about speculating the market, trying to tell where will the market go and then being able to profit from it. Market analysis helps traders to identify potential profitable trading opportunities, decide on their entry and exit points, and manage their risks effectively. It's an essential tool for traders who want to make informed trading decisions based on objective and reliable information. So there are three major types actually of market analysis, but I'm just going to talk about two. Some people don't accept the third, while some do. So the two major are the technical and fundamental analysis. Then you can say the third, which is the sentimental analysis. But we're talking about the technical and fundamental in this lecture. So what is technical analysis? Technical analysis is the study of historic price action in order to identify patterns and determine possibilities of the future direction of price. So in technical analysis, you get your information of price direction from previous charts, from historic price data. So we're going to be learning about candlesticks and see how they print and every other thing. But first of all, we have to understand that this is where price action is studied. This is where you hear different terminologies of chart patterns. You have rising triangle, you have falling triangle, you have flag pattern, many names. You have support and resistance, you have ranging market. So this just has to do with the price action. You're not using anything outside the price, historic price data to determine where price will go. Now, you should know that technical analysis can be very subjective. So I can be seeing a triangle. Maybe the chart is forming a triangle and somebody be seeing a ranging market. Somebody may be seeing another chart pattern. So it's based on perception of the trader, which is why the use of clear rules are to be established when picking a strategy. So when you want to make a strategy using price action, it's very important that you establish clear rules because sometimes it can be very deceptive when you are seeing the charts. Technical analysis focuses on chart patterns, trends, and market momentum to predict future price movement. Like I mentioned before, different type of chart patterns. You see uptrend, downtrend. I'm going to explain all that today. Market structures and so on. And then people also use what we call indicators. I won't be going through indicators, all indicators. We're going through a few that are relevant because price action is what you need. You don't need indicators. Indicators are just mathematical interpretation of what price has already done. Understanding price action is key to predicting price. Then the second is fundamental analysis. What is fundamental analysis? Fundamental analysis involves evaluating the intrinsic value of an asset or security based on factors such as economic indicators, earnings report, and the news. You have to understand the reason why and how certain events like an increase in the unemployment rate affect the country's economy and monetary policy, which ultimately affects the level of demand for its currency. So this is like a long-term view of the market. Technical analysis give you a short-term view. It can also give you a long-term view based on the time frame you're analyzing the market. But fundamental is always a long-term view. It's not something you use to go into the market and come out immediately. This takes in the information on the interest rate, the economic stability, political stability, how the economy is doing. It brings in different factors that affects the economy of a country in the long run. So fundamental analysis is where people use news, that they get concerning a currency to trade the market. But for this mentorship, we're going to be majorly learning the technical analysis and not fundamental analysis. So now we're going to talk about a price chart. So I'm mentioning a price chart since. Now a price chart depicts changes in supply and demand. So a price chart just shows you the price changes. And then we have three different types. We have the line chart, we have the bar chart, and then we have the candlestick chart. So this is what we're going to be using. And it's the most popularly used, the candlesticks. So we'll be learning about the candlesticks. The anatomy of the candlesticks. Now, different trading platforms use different colors for their candles. Some use, especially for bearish candles and bullish candles. So a bearish candle is a candle that opens higher than it closes, while a bullish candle is a candle that closes higher than it opens. It just means an up candle for the bullish candle and a down candle for the bearish candle. So let's look at the bearish candle. So most trading platform, you as well can change it to whatever color you want. But most trading platform, you would see that the bearish candle is red. Red means the price is selling down. Green means the price went up. So let's just look at the bearish. This point here, as you can see, this arrow pointing here is the open. This is where the price started. And then the price here is where the price closed. So a candlestick measures price movements per time. And we have different time frames for candlesticks. So we have the 1 minute candle, the 2 minute, we have 3 minute, we have 1 hour, we have daily candle. So it is just historic price move in time. So let's assume this is a daily candlestick. What this means, all this interpretation is showing you is that the price opened here and then moved up to form the high, and then came down, formed a low, and then closed below the open, making it a bearish candle. This full part where we see between the open and the close is called the body. And then the highs and lows that we form are called shadow, or we call them wick, usually called the wick of the candle. So we have the upper shadow and then the lower shadow. The same for the bullish candle. Let's say this is a daily bullish candle. So price opened at this point, formed a low, moved down to form a low, which is a wick, and then moved up to close above the open. So it is this place is called a close. After forming a high, this wick here, the upper shadow we can see here. Now, the distance between the open and the close is called the body. So this candlesticks makes it easy for us to read price properly than using a line chart or a bar chart. So candlesticks are easier. So you may find the other type of charts easy to read, but this one is what we're going to be using for this mentorship. If I should explain the other one, let me just give you a brief explanation of the other type of price charts. So your line chart, you just see it move as a line. You don't see anything like the open, the close, the high and low. It just moves, just showing your price movement. But the bar chart, you can see here now, this will be a bullish bar chart. Why? Because it closed above the open. So let's say the close was here and then the open wanted to be a bearish chart. So it's just showing the low, the high, and then the open and close. So market opened here, came down, went up, came down a little, and then closed. Very simple. Now, time frames. Time frames refer to the length of time for which price data is displayed on a chart. The time frame represents the length of time it takes a candle to print. Example include monthly, weekly, daily, and even minutes. So we have different time frames. The time frame just means that the amount of time it takes one candle to print. So if you're on a daily time frame, every candle represents 1 day. If you're in a weekly time frame, every candle represents 1 week. And then if you're in a 1 minute time frame, then every candle you see represents 1 minute. So very simple. Market structure. Market structure gives context to price action. Market structure helps to give a narrative of what price is doing. It helps tells the story what market is doing. Now we have two types. We have the bearish and the bullish, and they're called bearish swing and bullish swing. Now, what forms a market structure are three candles. Most people will say four, most people will say five, but actually it is formed by three candles. And to qualify it, the candle at the right has to be lower than the candle in the middle, if it is a bearish swing, and then the candle at the right has to be lower than the candle in the middle. So it forms this candle pattern, this triangular form, where this middle candle comes out. So we have a lower candle here and lower candle here, forming a bearish swing. The reverse is so for the bullish. So the candle at the left is higher. That is the low of the candle of the left is higher than the low of the candle in the middle. And the low of the candle of the right is higher than the low of the candle in the middle. So it forms this pattern, this triangular form pattern, a bullish swing. Now when this swing forms, I'll use the bearish swing here. There is high probability that the next candle that will be formed will be a bearish candle. Same for the bullish. When this pattern is formed, there is a high probability that the next candle that will be formed will be a bullish candle. So it doesn't happen all the time, but it helps you tell what will happen next. So let's say these are daily candlesticks. Now, if you see this pattern here, it helps you know what the next day will be. So you can assume to say that the next candle that will print, the next daily candle that will be printed here will be a bullish candle, meaning that that day will be bullish. So it doesn't happen all the time. There are other things you have to put in place and consider when making such analysis. All right, this is a picture showing price printed in candlesticks. So let's assume this is a low here. This is a bullish swing. Now that one was formed here. If you look at it, the candle low to the left is higher than the candle to the middle, and the candle low to the right is higher than the candle in the middle. So you see this pattern here. Then we see another one here again. This is a what? A bearish swing, because the candle high to the left is lower than the middle candle's high. And then the candle's high to the right is lower than the middle candle's high. So it forms this pattern here. Then if you keep going, you see another pattern formed here, a bearish swing. You look at it, came down, and formed another one again, a bullish swing, a bearish swing, a bullish swing, a bearish swing, a bullish swing. It moves up, a bearish swing, a bullish swing, a bearish swing. A bearish swing here, sorry, a bullish swing. Like that. Then now, why I brought this picture is to show us how price moves after forming swings. So if it forms a bullish swing here, you will expect that price continues to be bullish until the bullish swing that was formed is broken. So you can see that this low was formed here. And then, although it formed a bearish swing, giving you signal that market is retracing, then formed another bullish swing, and then it moved up. So now this price here, market is bullish until this low is broken. So we see how price moves from bearish swing to bullish swing, from bearish swing to bullish swing, from bearish swing to bullish swing. This is just to give us an overview of how price moves. Don't worry, I'm going to give an in-depth explanation of market structure. Well, what I want us to get from this lecture is that market structure forms with a three-candle pattern, where the middle candle is either higher for a bearish swing or lower than both candles at the left and right for a bullish swing. Market profile. So market profile has to do with price swing and trend. These two things. They tell you the market profile. Market profile just describe what the market is doing at the present time. It just gives a description, a snapshot description of price action. So now for price swing in trading refers to the movement of price in either direction, up or down. So now, types of price swing. So we have the bullish swings, which is in the up direction. So a swing is just a move like this. So if it creates a bullish swing price candle structure, that is the one that the middle is is lower, it tells that price wants to go bullish. I hope you understand. So we have the bearish swings, we have the sideways. So a bearish swing is just a swing that moves down. You see price going down. Why the sideways is when price is consolidating, moving in a range, as you see here. All right. So the second aspect of a market's profile is the price trend. So we have the bullish trend, we have the bearish trend, and then we have a choppy trend. So we're going to be seeing different types. Now, a trend is formed by swings. So we can see this movement here is a bullish swing because price is moving up, and then it retraces by forming a bearish swing. The moment it moves and breaks the previous high that was created, it forms a trend. So you see price move from here, a low to high, then from this high to a higher low, forming a bearish swing, and then moves to break structure. Because I told you that a structure, market structure, either bullish or bearish structure, is formed by that triangle pattern. So what would you think was formed here? This will be a bearish structure. You can see here, this placing. So what would be seen here, if you zoom in, you'll be seeing this pattern here. You see? So this will be a bearish structure. So price breaks above this structure. It's called break of structure. When price breaks above a market structure, it's called break of structure. You can see it here, BOS. So as soon as market breaks structure, you see that price will also retrace, forming a higher low, which is higher than this low. So this together forms a trend. So a combination of swings in one direction, either upwards or downwards. So this is a bullish trend. So upwards, it's called a bullish trend. And then once this trend is formed, it is expected that it continues to go higher. So there is high probability that if this high is broken, after retracing, you want to see this high broken. Then if you retrace again, you want to see this high broken. If you retrace again, you want to see the next high broken. So it is a bullish trend. You hear of terms where they say follow the trend. So if it is bullish, you want to be buying because there's strength. It means there is huge amount of buyers. Price is increasing. So as we have the bullish trend, we also have the bearish trend. It's just the reverse of the bullish trend. Price forms a high, it moves down with a bearish swing, and then retraces, forming a bullish swing, forming a lower high that is lower than this high, then moves to break the low that was previously formed, which is called the break of structure. So the structure that will form here will also be the three candle pattern, which is a bullish swing here, because it starts this bullish swing. When you see this pattern here, you are expecting that the next candle you printed will be bullish for it to move up to create this bullish swing. So the moment price breaks this structure after retracing, forming a lower high that is lower than this high, you are expecting it to move down to break this structure that was created while retracing. So you want to be in a sell when you see something like this because the trend is bearish. So you want to follow the trend. All right, this is an actual chart showing you a bullish trend. So we see how price formed a low, then it moved up to break this high, it retraced, formed a higher high, then it moved up to break this higher high, forming another higher high. The price retraced, then broke this high, retraced, broke the high, retraced, forming higher highs and higher lows, higher highs, higher lows. So you want to be buying when you see something like this. You don't want to be selling. So most times when you are here, you think that, let's say market prices at this point coming down, you will think that price is going down or you should be selling. Don't be deceived. When you see a trend like this, you want to follow it. You want to wait for it to retrace. Then when it is at a cheap price, you buy. You wait for it to retrace again. When it's at a cheap price, you buy. And then when you want to take out is above previous highs which were formed, like you can see it. So you expect that price goes down in value and then move up to break the previous high, which was created before the low was created. And this is also a bearish trend, the reverse of the bullish trend, when price is going lower, forming a low, a lower low, and then a lower high, a lower low, a lower high, a lower low. So see how price keeps breaking the previously created low, keeps breaking it. After it breaks it, it retraces. Comes down, breaks it, it retraces. Breaks it, and then retraces. Now, market is not perfect. It doesn't happen like this all the time. We should be aware of that. So this is a choppy trend. You can see that price is neither moving up or down. Price came down, it broke the low. So if it breaks this low, we're expecting it to retrace and then break the previous low that was created, then retrace and then still break this low. But no, that was not what happened here. It went up and then broke the high, and then we're expecting to retrace and then break the high that was created. But no, it came down, broke the low, and then it came down, broke this low, retraced. I was expecting it to move up to break the high, and which it did, to retrace and then break this high, but no, it came down. So when price is neither going up or going down, but moving in different directions, we call it a choppy trend. This is when you should sit on your hands. Avoid the market. Do not trade at this time. This is when you want market to tell you what is happening. Either it is trending upwards or trending downwards. But when it is choppy, you don't want to be in the market. All right. So I want to explain something that is called shift in market structure. Now I explain to you that trends are created by price swings. And before a swing is created, you will see a market structure. The market structure helps you tell you the beginning of a swing. So here now, what will you expect to see? You expect to see two candles that are higher than the middle candle. That is the low of these two candles. They forming this three candle pattern. What you're going to see here is the reverse. You want to see three candle pattern form, but the middle candle higher than these candles here. It is to tell you that this price swing wants to retrace. So when you see this candle pattern form, it is a telltale sign that, okay, price wants to retrace. So swings form trend. Very simple. But then there is something called shift in market structure, because the market was going bullish, and this market should remain bullish until the low that was previously formed is broken. So now we want to see market go like this, up, down. This retracement should not break this low. Instead, it should continue to break the high. Markets should keep breaking the highs that are formed. As long as the highs are broken, it is a bullish trend. But the moment that the low, which was formed after a high was broken, once it gets broken, it is called shift in market structure, because that is not supposed to happen. That breaks the rule of a bullish trend. So therefore, it changes from bullish to bearish. I hope you understand. So like we can see here, market started coming from this point, it came down, it went up. It should not break the low that was previously created after the high was broken. So once it retraces, it should not go down like this, and then because it helps you tell where you should place your stop. So if you place a trade, you should know where to place your stop. You shouldn't just place your stop randomly. A stop loss is placed where if price gets to, the trade is no longer viable. The trade fails. So if you are expecting that price would continue to go high to break these structures from there, and price does not, and price breaks instead the low that was formed, then you should be out of the trade. So you should place a stop loss there, meaning that if price breaks this low, the probability that price will continue is very low. So we should know that stop loss helps to prevent these losses from happening. And we gain the information from market profile and market structure. So I will explain it again. Price started moving from this high to this low, and then it broke this high with a bullish swing, forming a trend, and then it retraces, forming a bearish swing, and then it moves up to break the previous high which was created. Now we expect price to retrace to this point and then continue. Let me draw it here. So we want price to retrace and then continue, but instead price did not do that. Price broke this low, the higher low that was created, which is also called break of structure. So this here that we can see is a shift in market structure. What did it shift from? It shifted from bullish to bearish. So I hope you understand. Now, this is a price swing. It's something I want to also explain with this diagram again. We all understand what forms a market structure, a bullish or bearish. It is the three candle pattern, not just using this. You don't just say, okay, this is the market structure here, 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 because you don't see this until it is formed. All these are just in hindsight. So before this is printed, let me take off this drawing. So before all this is printed, you can see this three candle pattern here. So when this three candle pattern is printed here like this, you can be aware that it's printed because it has formed what? A bearish structure. It gives you a signal that this bullish swing is coming to an end. It is time for it to go down. Although you can see multiple swings here, you combine this with other things which I'll teach in our later sessions, where you're able to tell that, okay, now this movement here is coming to an end. So it's time for me to buy. Sorry, it's time for me to sell. Do we understand? So I just brought it here to explain that. So the second thing I want to explain is the shift in market structure. So I'll just use this point here. Now, market moved down, came up, moved down, came up. You don't want the previously high, because this is a bearish swing, right? You don't want the previous high that was formed to be broken. So market came down, went up, came down, went up, came down, went up, came down, went up, came down, went up. As soon as it broke this structure here, it become what? Bullish. So market retraced, went up, retraced, went up, retraced. As soon as it broke this structure here, this bullish structure here, which is not supposed to be broken because market should continue going up, coming down, going up, coming down, going up. So as soon as it broke this structure that was formed there, it became what? Bearish. So when there is a break in structure in the opposite direction, it is called a shift in market structure. A market should shift from the previous structure it was moving from to the reverse. Do we understand? So market should be breaking structure upwards if it is bullish. And if it is bearish, market should be breaking structure downwards. But if it is bullish, our market breaks structure downwards, it is called a shift in market structure. So probability is that price should continue to go down. It has moved from bullish to bearish or from bearish to bullish. Do we understand? And the market structure help us determine when price changes or shifts in structures. So if you see this low is bearish and this is a bearish swing, right? So we want to see a continuation of breaks in this low. So we can see this low, it was broken here. This low, it was broken here. This low was broken here without the previous highs that were formed being broken. You see this low, it was broken here. This low broken here, but these highs were protected. And the price moved. Once it broke this high, what happened? It turned bullish. It shifted from bearish to bullish. The price moved, retraced, broke these highs, went up, and then retraced. Now, market is not perfect. That's why I also brought this one here. We can see that price moved up, about retrace and break this, but still continued higher after which it broke. Now, this is a run on liquidity. Later on, we'll learn about liquidity. Look at how price runs liquidity and then reversed. So this is a reversal. We'll learn that later. So market is not perfect. I brought this example for that purpose so that we see that it's not actually perfect, but it can help determine the direction of price. You are going to lose trades. Don't think that all the trades you will get are going to be perfect. There are trades you will lose, and they are called cost of doing business. You can't do a business without paying a cost for doing that business. So you have the mindset of being perfect. If you're a perfectionist, then you have to change that. You have to be willing to take losses. because all your trades are not going to be perfect. You can't conquer the market. You can only conquer yourself.